Hello and welcome. In this lecture video, I'll be talking about short-term notes payable and also doing some quick check problems associated with short-term notes payable, okay? So this starts on page 253 of your course pack. So a short-term notes payable is just a written promise to pay a specified amount on a future date within 1 year, because it has to be short term, so it's classified as a current liability. So that's why we see the 1 year here, or the operating cycle, whichever is longer. So this is kind of the mirror opposite of those short term notes receivable that we talked about back in chapter 9. So in chapter 9, we were talking about using, for example, a notes receivable to extend a past due accounts receivable. We were talking about notes receivable when we lent money to another company. In this situation, we're going to be talking about the mirror opposite of that, where we are running behind on paying one of our accounts payable, and so we ask to extend our accounts payable by issuing a short-term notes payable. And then we're also talking about the situation when we borrow money from the bank. So think of this as the opposite side from what we talked about in chapter 9 when we talked about notes receivable. Now we're talking about notes payable and short-term notes payable because they're current liabilities, okay? So just like what we talked about back in chapter 9 with accounts receivable, we're talking about also promissory notes. So in this case, we are the maker of the promissory notes. We're the ones signing the promissory note and saying to the person that we borrowed money from, we're going to pay you back. And remember, on that promissory note, just like what we talked about back in chapter 9, it lists the interest rate, it lists the duration of the note, and we also have to sign it. Okay, so that's what gives it a little bit more legal teeth, okay? And so that documentation is helpful when resolving disputes and pursuing any legal actions. Also, they do contain interest, and we talked about that back in chapter 9 with our notes receivable. And now in chapter 9, we talked about interest revenue. Remember, because we are the ones issuing the notes receivable. In this case, we're the ones issuing notes payable. So rather than having interest revenue, we will have interest expense. And again, as I said earlier, it can arise from various transactions, but some common ones would be a company purchases merchandise on credit, okay? And then they can extend that credit. Maybe we can't pay our accounts payable right now. We're running low on cash. So what we do is we say, all right, we're going to extend our accounts payable by issuing a notes payable, okay? It also can arise when we borrow money from a bank. So let's look at the situation where we're going to use a notes payable to extend our credit period. Okay, so basically this is the situation where we purchase merchandise on credit. Okay, we purchased merchandise on credit, and we debited merchandise inventory, and we credited accounts payable. But then we're running low on cash, or for whatever reason, we ask our supplier and we say, look, we know the accounts payable is due, but we can't pay you now. Can we extend our accounts payable by giving you a notes payable? And then hopefully our supplier says yes, and then they have a notes receivable, and then we have a notes payable to them. Okay, now again, why would they want to do this? Well, they receive interest, and then this way they also don't have to write off their receivables. And we are signing something that says we promise to pay you. Okay, so let's look at the example. On August 23rd, Brady Company asked to extend its past due $600 accounts payable to McGraw. Okay, McGraw agrees to accept $100 cash and then a 60-day, 12%, $500 note to replace its existing $600 accounts payable. So we're Brady, and we're the ones that are asking McGraw to extend our payable to them, and then they're receivable from us. Okay, so what do we do? Well, remember, when we purchased merchandise inventory, let's say we purchased merchandise inventory for $600 from McGraw, and let's say we did that 2 months ago. So 2 months ago, we debited merchandise inventory, and then we credited accounts payable. So what we have, if we think about a T account, we have AP accounts payable, we have $600 over here. So what we're going to do is we're going to zero out our accounts payable, and then we have to pay $100 cash now, and then we're going to then issue a $500 note payable to replace this $600. So this is what we want to do. So we have to debit accounts payable. We're going to debit accounts payable, put the date of 8/23. I'll debit AP, my abbreviation for accounts payable, for $600, and we're paying $100 cash. Credit to cash, $100, and then I have I'm issuing a $500 note payable, so I have my credit to notes payable for $500, and that's my journal entry right there. Okay? Now, let's look at the situation on August 22nd, so it's a 60-day, so that would be August 22nd, that's when we have to pay it. Okay? That's when we have to pay it. And when we have to pay it, we have to pay the principal of the note plus the interest. Okay? We have to pay the principal of the note plus the interest. So, first thing is we have to figure out how much interest do we have to pay, right? Well, remember that's going to be equal to our principal, which is $500, and our interest rate was 12%, times the fraction of the year, which is 60 days. And remember, we use a 360-day year, which equals $10. Okay? That's $10 interest. So when we pay it, we are going to debit on 10/22. We will debit our notes payable for our $500, right? Which was the principal, and that's what we did on the prior page. Remember, we credited notes payable for $500. Now we're paying it off, and so we're decreasing the liability. And how do I decrease the liabilities? With a debit. So I will debit my notes payable for $500. This is my interest expense. Debit to interest expense for $10, and then I credit cash for the principal plus the interest for $510. Okay? So that's my journal entry when I pay it. Now let's look at this situation, the other situation that another situation that we could use a notes payable for, which is to borrow money from a bank. Okay? So the bank is going to require us to sign a promissory note. And so when that note matures, we're going to have to pay the principal plus the interest. Okay, we're going to have to pay the principal plus the interest. So this would be an example promissory note right up here at the top of page 256. Gives us the face value, which is the principal. Here's the date, and then it says 60 days after the 30th. Okay, so we would have to calculate the maturity date, just like what we did back in chapter 9. And then here's the principal, and then it's 12% annual interest rate, and then we have to sign it. Okay, so let's look at our journal entry for taking out a $2,000 loan. Okay, we're taking out a $2,000 loan. So on the date the note is issued, September 30th, 9/30. Well, think about this in terms of if you have student loans, what do you get? You get cash, and then you have a liability. So I'm going to debit cash because we're borrowing money from the bank, so we're getting cash. Cash is an asset, and the way it increase an asset is with a debit. So debit to cash, and then credit notes payable. Okay, that's my journal entry. Now this is due within 60 days. That means November 29th. Okay, so November 29th. So how much interest are we going to have to pay? Well, remember, we take our principal times our interest rate, which is 12%, times the fraction of the year, which is 60 days, divided by our 360-day year, and that gives us our $40. So we could come over here and we will debit our notes payable for the principal, $2,000. We debit interest expense for the $40. And then what do we pay everything with? Whenever you see paid, you credit cash. 2040. So when we pay off the note, we pay the principal plus the interest. Okay? So credit to cash for 2040. The other thing that we have to talk about with regard to short-term notes payable is we have to do an end-of-period interest adjustment, just like what we did in Chapter 9. Remember in Chapter 9, we had to do an end-of-period interest revenue adjustment? So, for example, we had a notes receivable on December 15th, and at the end of the accounting period, the end of the year, we had to recognize interest revenue from the 16th of December through the 31st. Okay? And remember, we debited interest receivable and we credited interest revenue. Now we're talking about interest expense, right? So what we're going to be doing is we'll calculate interest the exact same way, which is the principal times the yearly interest rate times the fraction of the year, and we use a 360-day year, and then we will debit interest expense and credit interest payable. Okay, that will be our journal entry at the end of the year. So we can say over here, returning to that example, the company borrows money rather than on 9/30th, we borrow money on 12/16. Remember, that was our $2,000, 12% interest rate, and then 60-day note. 60 days. So those were our assumptions. Well, on 12/31, let's say that rather than on the 30th, we borrowed the money on 12/16. So on 12/31, we have to do our end of period interest adjustment, right? So what we would do is we would take our 2,000, right, times our 15 days, and this 15 is from 12/16 until 12/31, times 15 divided by our 360, okay, times our 2,000, which is going to be equal our 10, okay? And this is a typo. It should be 15 divided by 360. Sorry about that. Okay, so it equals 10. So what we do is we debit interest expense, which is another expense on the income statement for $10, and then we credit interest payable for $10. That's our journal entry on 12/31. And again, the reason that we have to do that is per the matching principle. So we're using this loan during this accounting period to help us in company operations and to generate revenue. So then we have to match the expense associated with that loan in the same period for which we receive the benefits for using that loan. So think about it this way. We got 15 days worth of benefits in this year, so we have to recognize 15 days worth of expense in this year because of the matching principle. So on February 14th, which is 60 days later, right, we have to pay the note payable, okay? So we're going to debit notes payable for our $2,000, which was our principal. Remember that? And then we will debit, we're paying off this interest payable, so we'll debit interest payable for our $10. And then we also have interest expense in this accounting period from February 1st until February 14th. That number of days, 45 days, right? So if you took our 2,000 times 45 divided by 360 times 0.12, you would get 30. Or what you could also do is you could say, remember, it's a 60-day note. So 2,000 times 0.12 times 60 divided by 360 gives us 40. That's $40 total interest. I've recognized 10 in the prior accounting period. That means I recognize 30 in this accounting period. Okay, so then I credit cash for $2,040 when I pay it. Okay, so these are all kind of the mirror opposites of what we did back in Chapter 9 with our interest receivables and interest revenue. Okay, all right, so I'm going to stop this lecture video now, and we will pick up on page 258 on the quick check problems associated with notes payable. Okay, thanks so much. Bye.